Salam and hello. Today we're going to talk about Islamic finance and some misconceptions around it. And we'll get ChatGPT to answer these questions so we can have an unbiased explanation. So let's do that. Hey ChatGPT. ChatGPT, in short, what is the difference between Islamic finance and traditional if you were to take out the religious aspect and look at it purely on paper?
Purely on paper, the key differences between Islamic and traditional finance are 1. Risk distribution. Islamic finance shares risk between lender and borrower, while traditional finance transfers all risk to the borrower. 2. Profit versus interest. Islamic finance earns profits through asset sales, leasing, or partnerships, while traditional finance generates income from interest on loans. 3. Asset-backed versus debt-based. Islamic finance requires transactions to be tied to real assets, reducing speculation, while traditional finance often creates money through debt issuance. Islamic finance promotes real economic activity and risk sharing, whereas traditional finance focuses on lending and interest-based returns.
Okay, so some people would say that Islamic finance is just interest masked as a fee. What would you say to them, and what's the difference?
I'd say the key difference is in structure and purpose. Interest is a time-based charge on money, while fees in Islamic finance are transaction-based and tied to real assets or services. 1. Interest, usury, charged for borrowing money, accrues over time, often compounding, making repayment significantly higher. 2. Fees in Islamic finance, applied for actual services, e.g. processing, administration, or risk-sharing agreements, e.g. leasing, cost plus sales. They are fixed, transparent, and not tied to time. Why? It's not just hidden interest. No compounding debt. You pay a set price, not an ever-growing interest amount. Risk sharing. Lenders take some risk instead of profiting regardless of outcomes. Asset-backed money is linked to tangible value, not just debt creation. The goal of Islamic finance is to create fairer, real economy-based transactions, whereas interest-based finance often leads to debt cycles and wealth concentration.
Perfect. So, what's more beneficial for the borrower, Islamic finance or traditional finance, and why?
It depends on the borrower's priorities, but Islamic finance is generally more beneficial because it eliminates compounding debt and promotes fairness. Here's why. Benefits of Islamic finance for borrowers. 1. No compounding interest. Borrowers pay a fixed, agreed upon amount rather than an ever-growing interest charge. 2. Risk sharing. Lenders share some risk instead of placing all of it on the borrower, reducing financial strain. 3. Asset-backed transactions. Every deal is tied to a real asset, preventing excessive debt creation. 4. More flexibility in hardship. Many Islamic contracts offer leniency if a borrower struggles to pay, unlike traditional loans that continue accruing interest. When traditional finance might seem better, more widespread availability and established infrastructure, lower upfront costs in some cases, e.g. lower initial payments for mortgages. Bottom line, for long-term financial stability, Islamic finance is a safer and less exploitative option because it avoids debt traps and ensures transactions are based on real economic value rather than speculative lending.
Perfect. So, is usury a major part of why there is such a massive wealth gap in the world today?
Yes, usury interest is a major driver of the wealth gap because it systematically transfers wealth from borrowers, often the poor and middle class, to lenders, typically banks and wealthy investors. Here's how. 1. Compounding debt. Interest grows over time, making it harder for borrowers to escape debt while lenders continue profiting. 2. Wealth concentration. Banks and financial institutions accumulate massive wealth through interest, while everyday people struggle to keep up with payments. 3. Debt dependency. Governments, businesses, and individuals rely on loans to function, keeping them in a cycle of repayment while financial elites benefit. 4. Inflation and purchasing power. Interest-driven money creation leads to inflation, eroding the value of wages, while assets held by the wealthy continue appreciating. Islamic finance as a solution. By eliminating interest and focusing on risk sharing and asset-backed transactions, Islamic finance prevents excessive wealth accumulation at the top and promotes fairer economic participation. This could reduce financial inequality and create a more sustainable economy.
So if Islamic finance was used all across the world, could it be a solution for many financial problems and wealth gaps in the world?
Yes, if Islamic finance were widely adopted, it could significantly reduce financial problems and wealth gaps by eliminating predatory debt structures and promoting fair economic participation. Here's why. 1. No exploitative interest. Without compounding debt, borrowers wouldn't be trapped in endless repayment cycles, preventing the rich from profiting off the poor. 2. Risk-sharing model. Banks and investors take on real risk instead of making guaranteed profits, leading to more responsible lending and economic stability. 3. Asset-backed transactions. Every deal is tied to tangible value, reducing financial bubbles and reckless speculation. 4. More inclusive growth. Since wealth isn't concentrated in the hands of those who control debt, businesses and individuals can thrive without excessive financial burdens. 5. Stronger local economies. With money circulating in productive ventures rather than accumulating in interest-based systems, economies would be more self-sustaining and less dependent on debt. While challenges like global banking integration and policy shifts would need to be addressed, Islamic finance has the potential to create a more balanced, ethical, and sustainable financial system worldwide.
Okay. So is there penalties in Islamic finance for mispayment?
Yes, penalties can exist in Islamic finance, but they are strictly regulated to prevent exploitation. Key differences from traditional finance. 1. No profit from penalties. Lenders cannot profit from late fees. Any penalty collected must go to charity, not the lender's income. 2. Only for deterrence. Penalties exist only to discourage late payments, not to generate extra revenue. 3. Compensation for actual losses. If a lender suffers a real financial loss due to late payment, e.g. legal or administrative costs, they can recover only the actual expense. Why this matters? Unlike traditional finance, where late fees often compound and increase debt, Islamic finance ensures penalties don't burden the borrower unfairly while still maintaining financial discipline.
Perfect. Well, there you have it. So here's an example about fairness. So there's a bank in Calgary that does Islamic finance, one that's probably the closest to comply with Sharia, and they don't charge any penalty fees for almost 12 months. So basically they're working with you and trying to figure out what the best solution is, and they're not just trying to exploit you and charge you penalties and make things even worse than it already is for you. So with that, there's a reason why it's called mortgage. Mort means dead and gage means pledge. So basically it's a pledge until death. So obviously there's a lot more factors that come into play for it to be compliant. But I hope that answers some of your questions. And just on a side note, Islamic finance is not closed off just to Muslims. It's open to anybody that wants to use it. Just as a disclaimer, I'm not associated with any institution. This was just purely for education. I wish you all the best. Have a great day.